In this video, we're going to be performing a deep dive on Archer-Daniels-Midland's dividend safety. To begin, let's talk about Archer-Daniels-Midland's business model. The company was founded in 1902, and since that time, it has grown into an agricultural giant that operates in 160 countries and generates annual revenue above $64 billion. It provides a wide range of products and services designed to meet the growing demand for food due to rising populations across its four business segments: origination, oilseeds, carbohydrate solutions, and nutrition. Archer-Daniels-Midland is a well-known dividend stock because of its compelling track record of dividend growth, with 43 years of consecutive dividend increases. Archer-Daniels-Midland is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with at least 25 years of consecutive dividend increases. Looking ahead, Archer-Daniels-Midland's 3.32% dividend looks attractive while safe at the same time. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Archer-Daniels-Midland's dividend safety in the context of the company's current earnings. When Archer-Daniels-Midland announced its fourth quarter financial results on February 5th, the company reported that it generated earnings per share of $3.19 for the fiscal year. For context, Archer-Daniels-Midland paid $1.34 of common share dividends during the same time period for a dividend payout ratio of 42%. Using earnings, Archer-Daniels-Midland's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Archer-Daniels-Midland's current dividend payment to its free cash flow. During fiscal 2018, Archer-Daniels-Midland generated negative $4.78 billion of cash from operating activities and spent $842 million on capital expenditures for free cash flow of a negative $5.63 billion. The company distributed $758 million of common share dividends during the same time period, so there was no free cash flow to cover the dividend. Therefore, using free cash flow, our conclusion might be that the company's dividend does not appear safe for the foreseeable future. However, further investigation reveals that this is not necessarily accurate. If we include investment activities, the company actually generated $1.8 billion of free cash flow, resulting in a free cash flow payout ratio of 42.2%. Overall, we are confident that the company's dividend is safe relative to the underlying free cash flow produced by the business. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Archer-Daniels-Midland's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the fiscal crisis that occurred between 2007 and 2009. Archer-Daniels-Midland's performance during this time period is shown here. Archer-Daniels-Midland's earnings per share declined by 25.6% peak to trough during the last recession. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle we will use to assess Archer-Daniels-Midland's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, Archer-Daniels-Midland generated $364 million of interest expense and had $8.4 billion of debt outstanding for a weighted average interest rate of 4.3%. The following image shows how changes to Archer-Daniels-Midland's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Archer-Daniels-Midland's weighted average interest rate would need to rise above the 16.5% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Archer-Daniels-Midland's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Archer-Daniels-Midland's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.